The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, soybeans were the upside leader in Wednesday's trade action. Corn put in another day of slight gains. We had continued support in cattle futures and in the hog market as well. Wheat was a little more of a mixed bag, but all in all, pretty solid day at midweek. Let's talk about it. Joining us for market analysis, Mike Zuzolo, Global Commodity Analytics. Mike, good to catch up with you again this week. I know I was out last week, so it's nice to take a look at things with you. Hope things have been well.
Well, mentally, Jesse, with the way the markets have been, I'm always out at this point.
You know, you and me both. I've said this to a few folks. I struggle to talk about the markets day in and day out right now, and I know a lot of farmers are kind of feeling the same. They don't love a lot of the price action, and here we are with a decent up day, yet you still look at the board and the price action and you go, man, these prices just are kind of ugly, Mike.
Yeah, and Wednesday is a day that is kind of a groundhog day for me because it was almost identical in feeling and in price action and the key price movers to right before the July 4th holiday, with big rains coming to fill in where a lot of the dry weather still sits in the United States, forecasts looking very wet, an Indonesian trade deal announced the night prior. All of a sudden we jumped, and it felt a lot like July 4th when we got the Vietnam trade deal and we were going higher on, I think what I would call it, Jesse, is a commodity demand low. That's what I'm gunning for right now, and I have been since right before July 4th. That's when I started talking to clients and subscribers about it. And this weather not being the driver to the upside, I don't think is actually a bad thing. I think it could be a very good thing. And so I think we're trying to put together and stage a low here. Wheat wasn't playing ball with that, but we can talk about that, why that was. But essentially, I think what we're doing right now is trying to go back up to those gaps that were left over from after July 4th, because guess what? That WASDE report was not a negative report. It's just the market does not feel like buying, or didn't feel like buying before Wednesday's trade.
Yeah, the market sentiment, it just feels like whether it is friendly news or not, a lot of the funds and things of that nature just keep selling it. But to your point, we kind of felt like we maybe got down against some downtrending channels here. Let's talk corn and soy first, and let's look at the Dees corn Nov soy spread. As I mentioned, beans were the leader on the day, Wednesday. What are you tracking when you compare corn versus soy right now, Mike?
I really like the fact that the beans did lead us out, because the key leader to the downside has been the meal, and meal really put together a decent showing, and we can look at that in a minute. But for the beans and the corn, you see those gaps left over from July 11th time period, or right before the July 4th holiday, right after the July 4th holiday, around 432 3/4 in Dees corn, and that's your white bar chart, and 1044 1/4 in Nov beans, that's your purple chart. The July 11th date that I just gave by mistake is a key level, because that was our report day. And as of Wednesday's close, both Dees corn and Nov beans have been able to get back above that WASDE report day high. That to me is that sentiment that you're talking about. And why I like the fact that beans rallied and led the rally was because not just the meal, but we've seen some unknown destination sales in soybeans. That's, I think, attracting the market's attention, especially the bears that added to their positions after the WASDE report. Speaking of the WASDE report, we did get a bearish WASDE report in soybeans, but the product market with bean oil was supportive, because it was matched up with trade expectations for a big jump in biodiesel and biofuel. So between those two things, I think soybeans really needed to be the key to the turn in the market, since I've dubbed them the leader to the downside.
Let's talk about the product markets as well, looking at a meal versus soy oil charts. And what are you seeing here when you dive into the product side of the soy complex? I believe we just had some NOPA numbers out, things of that nature. I mean, what are you tracking here, Mike?
Yeah, I mean, the NOPA number was great. I mean, it was the highest for a month of June, I think, ever. It was almost 186 million bushels. We had soybean oil stocks dropped 15% versus last year at this time. But on Tuesday, if you look at the very far left of that chart and that green and red bar, that 2016 low, that's what we've been gunning after by taking out that 265 support level and running down below that as of Tuesday. And so I think we're trying to carve out a low in the meal, and that's been a long time coming, as this monthly chart shows us. And the trade's essentially been buying bean oil and selling meal because of the domestic fuel and also because of the Chinese demand. I mean, we all know that Brazil has been taking the lion's share of the recent soybean imports by China. We haven't, to my knowledge, booked any new crop beans with China. And yet on Wednesday, there were Newswire's reports that President Trump was softening his tone with China on a couple other things like fentanyl in order to try and swing a more detailed trade deal. So this is where I'm going to say I think there's a commodity demand low in the making here, Jesse. The grains are very much part of that because the report showed very clearly either steady demand or increasing demand globally when it comes to corn, beans, and wheat. And I think, simply put, the end user is not going to buy right now unless he sees an improvement in the tariff picture. And the financial guy, the fund, is not going to cover his 200,000 plus contracts of corn shorts, net short positions, until he sees a reason to go after it, i.e. the tariffs. And mixed in that, I think, is the idea that the corn and bean yields here domestically are going straight up, and that they're going to be a whopper number either August and September or one or both of those months.
And you think about all of this too, the weather picture hasn't been a whole lot that's changed. You mentioned it. We're getting some rain into some dry areas of the Corn Belt, for instance, and throughout parts of the plains. And I mean, I hear some of the chatter of some pollination issues in corn, things like that. But man, Mike, by and large, weather just continues to be overall relatively favorable for corded soybeans.
I think you're 100% right. And I think domestically that is a key. But there again, if you flip that around a little bit and say, okay, if the market rallies here and it's not because of weather, that could be a really strong sign of a longer term low in this market. And I got to say, again, July 4th pre-holiday, we had the Vietnam trade deal, scattered details on it. Today, we had Indonesia trade deal coming off of after the close yesterday, scattered details on that. We know Japan's got a big election, nothing going there. We know South Korea is still working with us. We know India is still working with us. But agriculture is right in the middle of all these trade deals in almost every one of these countries. That's been the hang up, whether it's South Korea, Japan, or India. And so I think this is where the funds and the fundamentals come together. But Jesse, it's so strange to see that Wall Street is not scared at all of the tariffs, while LaSalle Street is worried to beat the band about the tariffs. We can't get a rally up until Wednesday on LaSalle Street with the grains, but Wall Street just keeps making new record highs. And so I think at some point something's going to have to give in the investment flows, and that's going to be something we're really going to have to watch. But in the short term, the key with my clients and subscribers right now is let's maybe buy into this market to protect our crop insurance base price. Let's go after those gaps left over from right after July 4th. And then let's see if we can get some trade deals done between now and August 1. And if we can, maybe we break above longer term resistance. And maybe we can even do that, even though the trade is very well aware of bigger yields coming in the corn and beans in the August WASDE report potentially.
Mike Zuzolo with Global Commodity Analytics is our guest analyst here today on Market Talk. Mike, let's take a look at this wheat complex, and I'll start with a WTI crude versus SRW wheat chart. You and I have looked at this before, and wheat was maybe the third leg of the stool in terms of futures price action on Wednesday. It kind of followed along with quarter beans, but when you look at the wheat complex, a lot of things here to unpack here at home and around the world. What are you tracking right now in wheat?
Yeah, this chart is very important to me personally in my analysis, Jesse, because after the WASDE report not feeding the bull and not giving us the idea that we have a seasonal low because of Northern Hemisphere wheat harvest being subpar or no better than average, and we've baked into the price a much better supply side, production side equation and number, we went back to the macros. And this chart shows you on a weekly basis the crude oil price in the bar chart versus a soft red wheat chart, the price in the purple line. And you notice that yellow bar chart, we're at 90% now, 0.899. That means wheat and crude are back to trading a 90% positive relationship on a 5-week running basis. And that's been steadily growing ever since the middle part of May, later part of May. And that says to me that we're still tied very much to the macros. And whenever I see the wheat and the crude oil do this together, they're thinking about tariffs. Now, one caveat to this is the Russian sanctions. My understanding in the Senate bill, and I'm still reading through it, trying to get confirmation of this, we know energy is going to be potentially hit with secondary tariffs. Agriculture is in the language. I've seen it in the Senate bill. It doesn't specifically say wheat, where I've seen agriculture. But if we go ahead and pursue these secondary sanctions on crude oil against Russia, it could also mean wheat. And that could also mean that wheat from Russia, crude from Russia are off the table for the most part for the world export market, unless you want to get penalized by the United States. And that's where the wheat and the crude have an extra special relationship here in the short term. So this is, as I said, very important to my analysis right now, because we really need these two to go up together and support the overall idea of a commodity demand low.
Well, thinking about weather as well when it comes to wheat, let's talk about some of the world conditions, world issues. And I know there's some interesting things you're watching still in Europe, in Russia, in Ukraine, etc. Talk to us about this a little bit.
Yeah, I'm doing a broad brush map here, just giving you the highlights of where the problem areas are. And this is a condition map of exceptional, favorable, bad conditions versus last year on all the grains and oil seeds. And notice that Europe and the Black Sea regions are in yellow, part of them in yellow, part of them in green, a little bit in blue. So meaning better than last year, much better than last year if it's green or blue. Need to be watching in Ukraine and in Western Europe, France especially. And this is an important map along with the next one that we have, because this map kind of zooms in on the topsoil moisture of what's going on in the Black Sea region and Turkey. And what we see here is that there's less than 10% moisture at pretty much all the levels that I looked at, pretty much less than 10% moisture at all depths on the current Ukrainian surface and just below the surface. And I will put it to you this way. My take with what I've been able to see through these maps is that we are on the verge, if they don't get the expected rains this next 10 days that they're supposed to, and they're not supposed to be heavy rains. But when you look at the soil moisture profile graph and you see it's the worst in 7 years, and you add everything together that I've looked at, I think we're really on the verge of a 2012 scenario for Ukraine if they miss rains in the middle here, in the middle part of July, because they've suffered all year long. They've suffered in the wheat, they've suffered in the corn, and the corn has not improved. And what caused me to look at this so in detail for you today, Jesse, is we've talked about Black Sea a lot over the course of the last few months, but it was really when they came out this morning, the government of Ukraine came out this morning and said, we're putting a 10% oilseed export duty or tax on all of our soybean and rapeseed exports at this point. And that's mainly because they're worried about what kind of production they're going to have. Their barley export price is at a 1.5 month high. Their wheat price at Odessa is at a 1 month high. Their corn now is at about $240 a ton. FOB Odessa, that's up from about $225 a ton back in January and February. There's a lot of data now coming together that would suggest to me that they're on the verge of losing their crop, and it's already starting to be seen in some of these prices. So this is something to talk about probably in 10 days if they didn't get the rains.
That's going to be an interesting thing to pay attention to. Throw out there as well. You got Russia's Savicon slightly raised its crop estimate, while ICAR slightly lowered theirs, but the two estimates kind of converging together in the last couple of days. But I'll say that with a caveat. Do we really know exactly how big or how small the crop is in Russia, Mike? I think sometimes
No.
that's a guessing game.
Yeah, exactly. And that's why I'm attaching the wheat to the crude so much now at this point, Jesse. And the other thing I'll throw out too, when you talk about Ukraine, yeah, you're only talking about the number 7 producer, but it's the number 4 exporter in the whole world. It's right behind Brazil and Argentina at about 24 to 30 million metric tons. But USDA has it at 24 million metric tons on a 30.5 million metric ton production. So they export almost everything out the door that they grow, and so it could be a big hit. And so this is where the world supplies, after the WASDE report, still are the tightest since right after the 2012 drought here in the United States. And I'm sitting here thinking to myself, what could really change the dynamic weather-wise in this market and demand-wise for us? And it would be something like that in Ukraine.
Let's talk cattle before we close out today. Let's look at the feeder fat chart that you sent over here on our video feed and look at that spread action. And, Monday I was worried. It looked like that cattle futures were taking a hit. And then here we go Tuesday, Wednesday with good strength and basically getting us back up to where we were to start the week, Mike.
Yeah, and this is where, when you look at the fundamentals and the technicals, in my opinion, here in the next 10 days or 15 days as we close out the month of July, it's really going to be up to the live cattle to hold the upside potential, because I think the feeders are the most vulnerable. And this is one reason why the feeder fat spread has now cleared $100 on a lead month basis. We only got up to about 75, maybe close to $80 back in 2014, 2015. So the feeders are very premium, and we've got a situation where the corn is now coming on. We know how long the funds are in feeders and how short they are on the corn. That investment side of the equation concerns me when it comes to the feeders. We also have the screwworm issue. We just don't know when that's going to pop. And the USDA says we're going to go back on track with Mexico and get those doors back opened up and start moving those cattle back across the border. That especially makes me nervous now that we've got this issue with Brazil and the beef and the 50% import tariffs, and beef packers and exporters in Brazil starting to take a look at whether they really want to send much beef up to us if it's going to be 50%. And at the same time, our own U.S. trade representative is doing a serious look, taking a serious look at Brazil's trading practices, and that includes ethanol and agriculture. So when I add that to the fact that USDA on their WASDE report came out with a 540 million pound increase in 2026 commercial beef production, taking us up to a level for 2026 of almost 26 billion pounds, only down about 1.4% from this year. They said the reason they did it was because they were going to have higher placements the second half of this calendar year. And everybody I've talked to in the cattle industry, except a couple guys that I work with, have said, how are we going to do that when the Mexico border shut? And one of the guys said to me, we do have a lot of yearlings out there. So whatever the reason, I've got 4 or 5 things that make me think the feeders are the most susceptible to a big correction, and it's up to the fats to not allow that to happen.
Real quick, let's talk feeder cattle versus corn. What are you tracking here when we think about, maybe finding corn to feed in the feedlots?
Yeah, this is where, between that and also, as I said, about the investment flows being so short corn and so long feeders, you can see going back to 2014 and 2015, we were down at 320 corn, and yet the feeder corn ratio still wasn't as exaggerated at 80 times the price feeders divided by corn. So we're really stretched on these spreads right now, and they're historical levels that we're stretched at.
Mike, great stuff as always. Anything final you would mention or reiterate to folks as we close out the show today?
Well, we've been right about the dollar, Jesse. Wednesday was quite a day because the Bloomberg broke that the president was going to fire Chairman Powell. The president, 15 minutes later in the White House, said, no, I'm not doing that. I'm not looking at that. We had a really big run to the downside in the dollar, and we saw a lot of changes in the commodity prices. And so that dollar still is a number one when it comes to holding everything together when it comes to the tariffs and the trade. So as long as we keep a weak dollar, I think we still have the chance to keep our demand, and therefore that commodity demand low, I think is a viable possibility here.
Good thoughts, and who knows, by the time folks hear this, maybe the tune has changed for President Trump, and maybe Powell's gone. We don't know. That's just one of many things we're watching. Mike, if folks want to learn more, they want to reach out to you at Global Commodity Analytics, what's the best way?
Best way is globalcomresearch.com. That's globalcom with 2M's research.com, and sign up for a 2-week free trial or give me a call if you have a specific question.
Mike Zuzolo, Global Commodity Analytics. Always good to talk with you, sir. Thanks for joining us.
Thanks, Jesse. Appreciate it.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.